Hello, hello. I am back with a very important topic today. It's one I'm very passionate about, and this is uncovering the biggest options trading mistakes that people make. These mistakes cost traders millions in premiums they could have gotten from a portfolio size that they just didn't get because they made a few mistakes, okay? So the best part of this video is that all of these mistakes are pretty easy to avoid once you know what you're looking out for, okay? Once you know what you should be avoiding, it's easy to avoid it. And if you want results like mine, where I got this 105% return in a year, you're gonna need to know how to avoid these pitfalls. So this is all what this video is about, and I can't wait to dig in with you. Okay, so one of the things that you need to be aware of as an options trader is that if your income is inconsistent or all over the board, or that some months you make a lot of money and some months you make nothing at all, that should be a rare occurrence for you. Your income should be more consistent. If it's not, it's because you're taking unnecessary risks in places and you think that that this options thing can't be consistent. And it can be. It can be. You just need to make better decisions with some of these things. So here are some of the mistakes that I see people making. They are chasing high premium stocks. They ignore doing their homework on simple fundamental analysis. The fundamental analysis that you need to do only takes 5 minutes per stock. So why wouldn't you do it? And then not managing risk properly. Okay, so those are the big mistakes. So what's destroying your options results is essentially chasing high premium stocks, or what expert traders call premium chasing. So some of us that are more established, behind closed doors, will say about this trader who needs to improve their game, look, he's premium chasing. It's like you whisper it to your friend and everyone knows what you're talking about. You're just somebody who's there for the fast money and you think it comes with no consequence. And that's just not true. It will come with some consequence. So what most traders do wrong is that they trade the wrong stocks and then their mindset is killing their returns. So I'm not the first person who has talked about mindset, but you definitely have to have a specific mindset if you are to become an expert trader. You can't get around it. It might sound woo-woo, but it's got to be done. All right, so let's talk about how they trade the wrong stocks. So unsuccessful traders often trade the wrong stocks. I'm going to move my head here so we can actually read what I have to say. Okay, so typically what they do is they trade options on hype stocks or the newest high flyer in the stock market. And that stock draws them in at an all-time high. They notice it because it's skyrocketed. They're like, hey, I want a piece of that. They get a little FOMO and then they jump in. That's often a trap. So let's discuss in more detail what they do. So they buy 100 shares of one of the hottest stocks everyone's talking about on social media, or even use a stock market scanner to pick stocks that are flying high, okay? They buy the 100 shares, they sell a covered call on the shares, usually at a high delta. That's the second mistake they make, because they don't want to have their shares called away. Because they're like, there's nothing that can go wrong here. This stock is just going to continue to go up, okay? Then the market at some point takes a dip, and guess what always happens? The new hottest stocks dip harder than the overall market, okay? They dip harder than the overall market because the institutional traders don't want to pull out of the tried and true stocks. They pull out of what's new because that has more risk, and they know that, okay? Retail traders tend to not grasp that concept. It's the same idea when retail traders maybe want to sell out of a stock. They'll sell their gainer because it is in green and they'll keep the red. Another big mistake people make, but we'll record a different video about that at a later time. So in my story here about what's happening, okay, when you buy these stocks on a high flyer, you sell your covered call and you sell the high delta covered call. The shares are now down 20% because the market dipped, and it isn't easy to pull in premiums selling calls at a strike price that meets the cost basis of their shares, okay? So in desperation and sort of like with lack of patience, the traders start selling calls below their cost basis, and you know what's going to happen next, right? The stock then rises again. It becomes ineffective to roll out. It becomes impossible to roll out. So they're either getting their shares called away for a loss, or they're spending money to buy back the call they sold and sell a new option just to hold on to their shares because they have this emotional attachment to the shares and the mistake they just made. So they're creating a second loss. So this is a trap. These stocks are a trap for traders that are new or inexperienced, or even traders who think they know what they're doing and they sort of get lured in by that FOMO. So here's another way that traders screw this up. they get away with trading a stock that is ripping for a good period of time. So they increase their position in their portfolio on that stock, thinking that the stock will keep rising, okay? And then lo and behold, a market pullback obliterates their position, which has just now become a massive part of their portfolio. And that's how that works. All right. And guess what? It doesn't work. That's the problem. It doesn't work. So that's the first thing that I see options traders do that is a huge mistake. We're going to get into another one here. Number 2, they trade the wrong stocks. So they trade junk. They trade junk stocks. So some traders look at the market like it's a casino. They're literally gamblers and they just come to the stock market with that mindset. These are the players that give options trading a bad name. Like, you know, somebody will say at a party, I traded options once and I did terrible, wiped out my portfolio. Yeah, because you went in there like it was a casino. So a lot of these traders see a meme stock like GameStop trading at all-time highs, or they see that it's pumping and it's probably going to go higher because it did it last time, right? And so they think they're smarter than the pump and dump scheme that's going on in some of these meme stocks. And they don't realize that the only smart way to play a pump and dump is to sit that game out to begin with. They want a piece of it, they get greedy, they get in there, and they get obliterated. Okay, so stocks like GameStop are obviously junk, but junk comes in so many flavors and colors. Most stocks that are a few dollars a share are junk. Okay, so if you've ever been tempted to buy stocks that your friend or neighbor tells you are going to be the new best thing, remember this. Expensive stocks are expensive because the companies are worth a lot. And cheap stocks are cheap because they aren't worth much. We're going to get into that more in a little bit, okay? All right, the third thing, they trade the wrong stocks, okay? Again, they determine that high premiums make for great options trades. Oh, I see so much of this on X, and it's just... Ugh. And it's a lot of the gurus talking about this too, and I just want to kind of shake them and go like, why are you doing this? Why are you teaching this? It's a terrible idea. So this is such a common mistake. An options trader, like if they're looking for stocks to trade, they can see a stock that has just a huge rate of return, and they don't even look at whether the stock has gone up lately, has gone down lately. They don't do fundamental analysis on the stock. They just look at that premium, and they go like, wow, look at this. That second out of the money call is going to be a 10 to 12% return that I can make in just 3 weeks. I'm doing that. They start to salivate over that return and just think about how big that initial payment is. But here's the thing. They may be holding that stock for a long period of time. So that initial payment, while it's really juicy, they're not thinking of the long term. So they don't realize that the reason that the stock has high premiums is because the market makers that actually set those premiums see that stock as high risk, okay? The only reason high premiums exist is because high premiums are a result. The premium that you are paid is in direct correspondence to the amount of risk the market makers see in that stock. And you can argue with me about whether you are smarter than a market maker or not. That would be an interesting argument to have in the comments below, but you're not smarter than them. Okay, so market makers reward you with premiums by taking on risk. A 10 to 12% return in 3 weeks is excessive and huge because the risk is huge. So what's the risk we're talking about? Huge swings in volatility in the stock price. Okay, volatility is great to a certain degree in options. Like moderate volatility is super fun to make money off of and play, and is highly successful in a quality stock, okay? But this would fall into the high volatility category of premiums, and you aren't smart going after this because you found a stock that can pay you high premiums. You are smart, however, if you realize stocks like these have just as much downside as upside, and the risk isn't worth it. Like most of the time, this risk is just not worth it over a period of time. You may get away with this once or twice, but it will come back to bite you. It just will. Gosh, how do I know this, guys? Because I've done it. I've done it. We've all done it. Okay, I'm just a word of wisdom. Don't make the same mistakes I made in the beginning. Okay, number 4 on they trade with the wrong stocks. They pick stocks that are fundamentally weak. Okay, you have to do your homework on your stock picks. If you see a great name A lot of times you might just think that that's a quality stock pick and that it's a perfect fit for options trading. That's not correct. Many great names and iconic brands are just not suitable to trade options on. So let's dive into some names here because I've got some examples, okay? We want our stocks to be increasing in value over time for us to be successful options traders. If that's not happening, you're going to be so frustrated with options and you're going to lose money. Unless you're buying puts on them, which probably isn't what you're doing, okay? That's not where most people start. But Nike, okay, let's talk about that stock. I traded this stock before, okay? So I learned this through experience with Nike, and I did great with Nike for years. It stopped being a good stock to trade options on, though. Why? They were once an industry dominator and a great stock, but their numbers on earnings and revenue have been down, and it's losing market share and popularity, okay? So you're not doing your homework. You're not like looking at their earnings and revenue and seeing if those are going up before you pick up that stock. That's a big mistake. Starbucks. Right? Everyone gets their coffee there, so it must be a great company, right? It must be great to invest in there and trade options on that. Fairly stable. No one's going to stop having Starbucks be their favorite coffee place, right? Wrong. Behind the scenes, the company needs a lot of restructuring. It's not doing as well as it should be. Again, earnings, revenue, that sort of thing. They had to hire a new CEO recently. You're not doing your research on this. Ford. Okay, so this is interesting. This is like a really old classic brand. It's been around forever. There's a nice dividend. It sounds good, but we need the stock to rise, and that just hasn't happened in years. And a lot of times some of these higher dividend paying stocks with the really great ratios just don't have high premiums to trade options on. And I know I just said don't chase high premiums, but you need to find enough premium there for it to be worth it for you to trade options on it, okay? So my overall message here is stock picks need to rise over time and make consistent money in options. So I see a lot of people just saying, I'm going to buy this stock. Oh gosh, Elf comes to mind right now. I'm going to buy this stock because, it's a great company and it's going to rebound. Yeah, good luck with that. It's been doing nothing but falling. I don't know what you're seeing there that's making you think that's going to rise because the data does not support it and you're a little bit delusional, to be honest. Okay, and then they have the wrong mindset. So guys, I'm going to boil this down into one point for you. One point only. And that's that you get greedy, okay? Now listen, none of us are immune to greed. None of us are immune to greed, okay? Most of the issues that we've gone over so far actually come from a bit of a greed mindset or a scarcity mindset. One of the two, okay? So you got to pull yourself out of both of those. But today we're talking about greed. So let's define greed for a moment. Greed is a voice in your head and we all have it. None of us are better than the other ones. Nobody's better than somebody else. Like we all have greed. We do. Okay. But how often are we listening to it? How long are we recognizing it as being this voice in our head that is not helping? Okay. That's what separates the men from the boys, as they say, okay? So everyone wants everything now, and greed doesn't like patience. So greed wants everything now. It doesn't like patience, and it wants us to act now. And greed is always in a rush. So if you ever feel rushed, probably greed. Greed sounds so sensible at times, telling us we should take risks, grab the bull by the horns, and be brave. We might even get giddy with our success and we start to think we're infallible. Like when you're making those huge returns, your ego kind of takes over and greed jumps on and goes like, yeah, more of this, okay? Greed asks us to break rules or not even make rules to begin with. It tricks us. So when we slip into greed, we often get into premium chasing, taking on risky strategies, and ignoring downside risk. So if you're doing those things, right? Getting into premium chasing, trading risky strategies, and ignoring downside risk, you're probably slipped into a green mindset. Not a big deal if you can right your ship. Again, we're all susceptible to it. We're all susceptible. None of us are better than the others. As far as, does greed talk in our mind? Absolutely, to every one of us. How often do we listen? That's what separates the girls from the women. All right. So how do we get consistent return? We have to eliminate bad habits and use these solutions, okay? So let's go over the solutions I've got for you. So the solution to problem number 1 of trading hype stocks. Make sure stocks pass evaluation of fundamentals. So, you guys know my fundamental analysis if you followed me for a while, but let's go over it one more time because I love sounding like a broken record. Okay. That stock better have rising 5-year, 1-year, and 3-month charts. The stock price should be increasing over time. Okay, I get this question a lot, or I see a trader come in and they're like, what about this stock? And I look at the chart and the stock isn't even 5 years old. And I'm like, red flag, high risk, no, new company. If it's not 5 years old, it's just a no for me. Or I'm taking a super small position on it. Super small, okay? Like less than 1% of my portfolio, okay? That company should have rising earnings and revenue for 4 years in a row. How you check this out? It's so easy. You go to Yahoo Finance, you plug in your ticker. On the left-hand side of the page, there is a little tab there that says financials, and you can see 4 years of earnings and revenue in 1 minute. Okay? Those numbers should all be rising. Okay? That's telling you that the company knows how to make money year after year after year and keeps growing. If they're not growing year after year, that's a problem. That's a problem. Don't ignore that problem. I see so many people ignoring that problem with Tesla, and I'm like, oh, you guys are going to get so burned. I rail on it on X, but anyway, another topic. That stock should also be an industry dominator or a monopoly. Okay. So this is obvious, right? Like if you're going to go out and buy a computer right now, are you going to buy some brand of computer that isn't like kind of the best if you can afford the best? No, you're totally going to get the best. You're going to get a new stereo system, or are you going to get like the one you haven't heard of? No, you're going to get like one of the leading ones because you've got some money, you want to invest in something that's going to be good for your home. You love listening to music. You're going to buy the good thing, not the thing that's sort of like off brand, okay? So you got to do the same thing with your stock picks. Also, why would you want to pick something that's trying to become as good as the thing you could have bought in the first place? That never makes sense to me. Like, you need to buy the industry dominators and the monopolies. Then, most stocks that pay a dividend are not hype stocks. Okay, the reason that they have a dividend to pay is because the company is already profitable enough that they can share their revenue, the money that they get in, their profits, with their shareholders. So this is actually, if you're looking for a positive reinforcement on if your stock pick is a good one, this is a reinforcement that you're on the right track, okay? And if there's a suspicion on your behalf that that stock could be a hype stock, trade it in very limited quantities. Again, like a very small percentage of your portfolio. And then don't make the mistake that I talked about earlier, which is when it starts really doing well for you, that you add in more and more and more, where it then becomes like 40-50% of your portfolio. Don't do that. Okay, so the solution to stopping trading hype stocks is when you see a high flyer and a stock that's just going through the roof, realize that there are very few stocks in the history of the market that have been high flyers that have run the course of time. Okay? And then do your fundamental analysis on them. If it passes the fundamental analysis, you still probably want to trade that stock in a very limited quantity of your portfolio. Okay, solution to problem number 2, trading junk. Don't find your stock picks on social media. Don't do that. Like you can see that people are talking about something and it doesn't sound like something that you really have heard of before. It's a big red flag. You want to look to resources like Yahoo Finance or Investors Business Daily to get stock pick information. Okay, you want to have people that actually really know about stocks and how they're doing, and have like actual read like financial statements and stuff giving you information about the stocks versus, oh, you guys, I love this stock, it's going to be so great. Like that, what does that mean? That means nothing. So only trade stocks that you want to own long term. So many people skip this step. It's like every good trader says this, and people skip over it all the time. They're just like, yeah, well, I could have a certain percentage of my portfolio that I don't believe in this stock long time. I'm like, what? What? I don't buy products for my house that I don't think are good, that are going to wear out on me, that are like not going to last the test of time. Like, I don't like buying plastic and throwing it in a junkyard afterwards because it broke on me right away. That's what you're doing when you do that. Don't do that. That's so silly. Okay, follow a stock for a while before you buy it. Okay, notice if you like how it behaves. there's no rush to buy any of these stocks. Like, you're here for the long term, right? So why not like examine how that stock does over a 3 to 6 month period of time and see if you like how it is working. Is it going up? Is it going down? Is the company becoming stronger? Is it becoming weaker? These are questions you should be asking yourself. Again, like, why are we taking time? Because greed asks us to rush. So we go, hey, greed, guess what? I'm not listening to you today. I am listening to actual data sets, okay? Remember that shares are cheap for a reason, okay? The company isn't that valuable. That's why shares are cheap, is because it's not that valuable. I mean, one of my mentors told me, and I was just like, oh my God, I heard that for the first time. Okay, there's more to this, okay? There's a little bit more to this. There's an exception, okay? Like if Amazon was once $3,000 a share, right, a couple of years ago, and it split into 79. Well, that's an amazing buying opportunity. Don't get me wrong. Like 79 is cheap for Amazon, but like, use some judgment here. Stock splits are the exception to the rule. A stock split means that company got really, really valuable and decided to split all their shares, which is a positive, not a negative. But that's like kind of the only exception to my rule here. You want to look for stocks that have over 70% institutional ownership. This is very easy to Google or just look up on Investors Business Daily or Yahoo Finance. And then you guys, this is like one of the ways that you can figure out if you're trading junk or not. Read market news every day for 10 minutes. Again, Yahoo Finance and Investors Business Daily are great. Once you start to read about how quality stocks are doing over time, you can really start to contrast that with what junk is doing. So I really love reading. You can't get around reading if you're going to be a stock trader. You just can't. You got to read. Okay. Solution to problem number 3 of premium chasing. You need to think really long and hard about allocation. All right. I'm going to move my head up there again. So an options trading portfolio should have a stock balance that matches your risk profile. Like, you know, when you go to your financial advisor and they're like, are you somebody who likes really aggressive or moderate or conservative? You as a trader should have a style like that. You should spend some time thinking about what your profile is. Are you a higher risk person, medium risk, low risk? Okay, so building an options trading portfolio or picking stocks to trade with for options is no different. A portfolio of primarily high volatility stocks has a much higher risk profile than a portfolio with a small percentage of volatile stocks. Remember that stocks can go high fast, but can also fall fast, okay? So a lot of times when stocks race off, we trick our minds into thinking the market is always going to be this way, or it's going to be this way for an extended period of time. Same thing when the market sinks. I see this more often when the market sinks. People get stuck in the mindset of like, oh God, I just lost a bunch of money and I'm not doing really well right now. And this is it. And it's like, this is today. 2 weeks from now, the story is completely different most of the time. So today is not forever. Just remember that, okay? You need to do advanced research on whether your volatile stock, if it falls 15% and you're trading it, how will that affect your options premiums that you're getting in afterwards? So when you're picking out your stock, you're not like, oh, I see the high premium, I'm going to go trade that stock. Or I like the premiums here, I'm going to go trade that stock. No, that's not what you're doing. What you actually need to do is a little bit more research and say, if this stock fell because it's volatile and it often makes $15 moves to the up and down side, what's it going to feel like if I buy at that top and it falls 15% and then I'm trying to sell covered calls from there? What's that going to be like? Is that going to be good enough for me? Is that going to be consistent for me? So don't get like stuck in the situation where you placed your first trade and now you're stuck because it's now occurring to you what happens when it falls. Figure out what it looks like when it falls before you get involved with it. That saves yourself a ton of heartache, okay? Choose quality stocks from known companies with legacies with an amazing past and future. Trade only stocks that you want to own long term. I can't say this enough times. So again, newer companies, they tend to pull back more. And these are the stocks that typically premium chase, is these newer companies that seem to have bright bright futures, come up with a new technology or a new thing that everybody's going to want, right? Okay. Everybody's going to want it. Not really. Not everyone's going to want it. So like there's some stocks that come to mind that are just like little tiny AI stock companies, not the big ones like the Googles and the Apples and the Metas and stuff like that, but these little AI accessory stocks where they just do something where they like do a foreign language translation. And you're like, oh my God, that's amazing. Everyone's going to want it. Well, not really. Just people who are studying foreign languages or need to transcribe something. So when you actually look at the whole population of the earth, that's not everybody. But you know who can serve almost everybody is like an Amazon. So like, why are you more interested in that stock than an Amazon? Doesn't make a whole lot of sense when you actually put some thought behind it, does it? And then just remind yourself, if something seems to be too good to be true, isn't that because it is usually? I mean, our parents are right about these sorts of things, right? And then consider asking yourself, am I trading this stock only to get the premium? And if the answer is yes, you're premium chasing. Pretty easy fix there. Okay, solution to problem number 4, picking cheap stocks, okay? So cheap stocks are cheap because the company isn't worth much. That's just our fact that we're willing to accept now. Many traders feel that trading cheap stocks is a good way to get started because they aren't risking too much learning how to trade options. I see this all the time. Like there's people that come into my course and they're like, I'm just going to trade like Chewy because my wife is only going to like let me have 10K to trade options on, and then I can do 2 contracts or 3 contracts to Chewy, and then I can prove to her that this options thing works, and then I can get more money and like we'll agree to put more money into this or whatever. And the issue here is that the results the traders get are going to be based on the quality of the stock that they're trading. So here the trader initially sets themselves up for failure while mistakenly thinking they're being protective about their money. I get the front end logic there. It's just wrong and it's flawed. What I would say to a trader like that is save your money until you can afford something that's quality. Or trade something that's quality with that 10K and only do 1 contract. So stocks that come to mind that are quality for me are going to be like more like the Walmart or Chipotle. You can't trade as many contracts with them, but more contracts doesn't equal greater amount of success. It just doesn't, okay? So you need to overcome the middle class mindset of believing that quantity is better. The amount of shares we own or trade is not important. It's important to own the best companies because the best companies are going to get you the best results. And those best results are going to come over an extended period of time. They're not going to come tomorrow. You can have success tomorrow. That happens a lot. But more often than not, and we're talking about how to be consistent here, consistency comes over time. Okay? So quality costs good money, and quality is often even expensive. Okay? I've learned to come to love the word expensive. Okay? Like, expensive is a good word. We should aim to buy expensive things. Because expensive usually means quality. So cheap is cheap for a reason, and expensive is expensive for a reason. I said it. I'm not taking it back. All right, and then solution to problem number 5 of greed. Okay? Greed is a mindset. We all fall into it from time to time. We talked about that. Accept that it happens, but know the warning signs. So how do we identify the warning signs? Take time to reflect on when losses occurred and see if you can relate that back to you being greedy and experiencing some greed feelings. Don't put any shame on it. I'm not asking. This is not to make anyone feel shame. This is not. But you need to identify the feeling you were feeling so that when those feelings arise next time, you can recognize them and stomp them out and go like, oof, you almost got me there. You almost tricked me, but I'm smarter now. So greed often feels liberating and enticing when it's luring us in. So you need to start becoming an unemotional trader. I find this comes through experience, but the more that you examine your actual feelings, the better trader you become. So in previous videos, I believe I've talked about how it's really important to be in touch with your feelings, because if you start feeling like alarm bells going off that something is too risky for you, or you're in your portfolio and you're seeing things sink and you get this horrible feeling, that's your risk tolerance screaming out at you. Hey, you're taking too much risk. Stop. Like, we don't like this. We need to dial back into some more conservative trades. because we're experiencing market and pullback and we don't like the way this feels at all. So we need to become more conservative. We do the same thing with recognizing our feelings around greed. Greed feelings feel intoxicating. They feel wonderful when you're experiencing the greed. When greed is calling out to you, you're like, that's a little devil on your shoulder telling you to do the wrong thing. And he sounds so cool to hang out with. Like, let's do some shots later, greed. But he's there to trick you, and don't get sucked into that. So set some time up to make a trading plan and then stick to your plan. Be realistic with goals and time frames. There's no rush. Your trading is forever. It'll be here tomorrow and the day after that. There's no need to make all the money that you need to make today or in a year. I was just talking to somebody earlier this week who was trying to make up for losses they had experienced in a stock 5 years ago with a new stock that was a high flyer. And they're trying to make back all that money in like a month. And I'm like, why? Does it make any sense? Like, that's greed. Okay. So, and I realized that greed was coming out talking to him in a way that was like, let's just try to make up for the past. Greed does that. Greed does that too. It just kind of asks us to be unreasonable. And what our job is to be reasonable. Okay. Risk management mistakes. Traders, so we're talking about the risk management section of this now, and it's really important. So here are some mistakes that traders make. Traders don't know when to leave a stock, okay? They don't stay informed about the stocks that they trade. They aren't in the know about news, world events, or trends. And they have a bias towards products, CEOs, Musk comes to mind, or services they like and assume everyone else will like them one day, too. So in other words, they speculate. Speculation will kill you in this market, or in any market, really. So here are some risk management solutions. You got to make a stock watch list on Yahoo Finance or Investors Business Daily or something like that, some kind of news source, and include all the stocks that you want to trade. This should be no more than 5 stocks for beginners. You heard me right, 5, and 20 for advanced traders. That's because you need to become an expert and follow the news on those. So like as soon as you plug in the stock tickers, Yahoo Finance is going to bring up articles about that stock and the industry that they're in. And you need to spend 10 to 20 minutes a day reading the news. You can pick articles that interest you. The thing is ignore the ones that maybe don't for now when you're beginning. But as soon as you start to own those stocks, you better read the articles that come up about them. Like, where are they expanding? Where are they shrinking? What are they moving into? What's their CEO up to? Like, what are the new ideas? What are their competition? What's their competition? Are they saying sales are declining in this area? Are they saying sales are increasing in another area? Okay. Make sure that you know how their last earnings call went. All right. So if you don't know, if you're involved with an individual stock and you don't know what their earnings are every quarter, I'm not sure you should be a trader, to be honest with you, because that's what you need to do. You got to do your homework to be respectful to your money. And if you're not being respectful to your money, it'll get taken from you. Okay. And if they had a bad earnings call, be on heightened alert if more bad news comes out. Okay. So yeah, you just want to make sure that you're letting all this data sink into you, and then you're having thoughts about it. You're assessing it. You're doing some analysis on it. Okay. It's amazing how reading 10 to 20 minutes a day will make you an expert on a stock in like 2 to 3 years. It's kind of crazy, actually. All right. So another solution. Make plans on when to leave a stock in advance so the plan can be acted on later unemotionally. So my plan looks like this. I already have a plan. This is my plan. I start getting out of a stock after 2 bad earning calls in a year. And I don't just rip off a Band-Aid and go like, I'm selling it all. No, I start paring down, okay? I move out of a stock if a stock has a declining share price over a 3 to 6 month period of time if the overall market is going up. All right, so those are my 2 rules, and yours could be different. But the point is make rules now in advance. That's what's important here. So you could come up with a totally different set of rules, okay? But the thing is, you got to have the rules. Never fall in love with a company or believe in it. Rely on data alone. Be willing to be wrong about a stock pick and then move on swiftly. So if you're really stubborn and just like, I love this company, I love the CEO, blah, 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 blah. I believe in this. Well, okay. Fine, whatever. But I don't know. It's just, oof, that's a big one for me. it's just not a good thing. It's almost like a culty feel. It's almost like you're a cult of a fan. Maybe buy their products, but don't buy the stock. How about that? That'd be a great idea, right? Okay, become a customer. Risk management. Know when to trade less. Trade less on days with huge market swings. There's a tendency to think what happens today will last weeks and weeks on end, and that's an illusion. So when there's just these huge movements to either side, I just sit out and wait. I'm like, okay, well, let's see what the direction is going to be after today, after even the day after that. There's no rush. I'm here. I trade with a lot of theta. That's why I trade with a lot of theta. So trade with a lot of theta. I didn't even put this in here, but that's a great suggestion as well. All right. And then risk management, our last thing is like everyone asks me, how do I know when I just need to leave the market altogether or like really sell a lot of stuff? So you got to know when to move into cash. That is imperative. Like there are, really there are times when you need to pull out of your options trades or your stock positions because the market is experiencing a pull off, and as an options trader, you need to preserve your capital. These are unpleasant things when they happen, and they happen rarely, thank God, but you need to make an advanced plan to leave the market at certain pain points. So my plan, I'm going to share it. My plan is to get out of positions if SPY breaks out of the bullish channel it's in right now. So right now we're in 2025 in March. SPY has been in a bullish pattern channel upwards for over 2 years. And the current current bearish marker that it would have to break out is 570. If it goes below that, I get a little bit like, big thing, big indicator for me. So your plan may be different, but the point is you have to have a plan so that your risk strategy is mapped out before that stressful day comes. Because that stressful day, you could have other stressful things happening. And you might not have the time to think about it and manage it. And you're going to make an emotional decision. And you might even make a decision out of greed again. So making a plan in advance always results in better decision making. The last thing we want to do is make large decisions under pressure. Make your large decisions in advance for better results. Okay, so that wraps up today's video. This was a fun one to make. They're always so much fun to make. But if you want to watch more from me next, and if you want to learn a full explanation of the 7 trades I used to make $400K in 2024 from a $600,000 portfolio, then watch the video below that I linked in this description. And if you want any help implementing any of what I've covered today or learning the trades that I mentor, there's a link in the description as well to book a call with me and take it one step further.